Is the stock market climbing a wall of worry? Hello, friends. Welcome back to another video update. Happy 4th of July. Go USA. I'm tuned into soccer like a bandwagon fan for sure. Just want to get that out there. I want to recap June as we move into July. So here we go. There's an old quote. This is going back to the 50s on stocks that says, the stock market climbs a wall of worry. What does that mean? This means markets will often rise or climb despite worries or concerns that are present. The concerns are usually very obvious. It's the economy, it's politics, all these kinds of things. But the market does not wait for perfect conditions to go higher. It looks ahead into the future. It looks through these unknowns. If an investor waited until things were all good, there was an all clear somehow, now let's invest, you would have missed out on a lot of returns. This idea applies today because many investors remain worried. High interest rates, inflation, geopolitical tensions, government debt, you get the picture. But there's always things to worry about. And that's kind of my point. War in the Middle East this year, tariffs last year, high inflation before that, very high inflation, COVID before that. Think of the past 20 years, go back 50 years or 75 years. Lots of wars and oil spikes, inflation and fear. Fear, fear, fear. I think our human DNA is just wired to have fear and anxiety. We can't get rid of it. So even with these uncertainties, the stock market has continued to reach new highs in 2026. This demonstrates the market often performs well when expectations are cautious. So let's get into some of the specifics. We had kind of a mixed bag of data from June. The June jobs report fell short of expectations. We added around half as many jobs as we'd had in recent months. Still, the unemployment rate ticked down to 4.2%, so that is holding steady. And despite some disappointment overall, the labor market is actually doing better than last year. Monthly job gains, 92,000 on average, is up from just 10,000 a month in 2025. How about inflation? Inflation remains an issue. The Fed's preferred measure of inflation, the PCE index, that's different than CPI. The PCE index rose to 4%, 4.1 specifically year over year. That's the highest level since 2023. That's double the Fed's target of 2%. We don't like it. Honestly, as energy prices come down, we expect that to drop back down as well. So later in the year, we're looking for PCE to be back in the threes, probably hitting 2% next year. That's what we're targeting. Okay, how about manufacturing? Let's talk about that. After reaching a 4-year high in May, U.S. manufacturing activity actually cooled in June as well. Growth in new orders slowed a bit, but we are still in expansion territory, so we're still expanding. That's really good news as we move into the back half of this year. Okay, the Fed. The first meeting of the Fed with the new Fed chairman, Kevin Warsh, who we've explained took over, decided to hold rates steady. This is seen as a renewed commitment to curbing creeping inflation. Earlier this year, rate cuts were anticipated. We've had rate cuts, and now rate hikes seem to be a distinct possibility. The market is thinking there'll be one rate hike this year. Time will tell. Globally, it's even more hawkish. The ECB delivered its first rate hike since 2023. The Bank of Japan raised rates. They're at a 31-year high. Our economists, going back to the economy as a whole, is looking for mid 2% for GDP for the year, about 2.4. And that is supported by strong consumer spending. We've talked about that in other videos. Equity markets, they experienced a wave of rotation, with tech losses making way for gains in financials, industrials, utilities, healthcare, other places. That is a really good sign. There's still tons of optimism with AI. There's still a lot of spending with AI. But throughout the month of June, investors chose to shift their dollars from one sector to another rather than outright selling, and that is a sign of confidence. During several days when tech was down big if you saw the NASDAQ. Non-tech sectors like healthcare, financials, real estate, these other ones performed relatively well. Also, consensus estimates point to 25% growth for S&P 500 earnings in 2026, far exceeding their expected 15 or 16% growth at the start of the year. We had talked about that. The bottom line, although the economy is still in the deep fog of uncertainty regarding Iran and other pressures, June's theme was resilience. That was led by a strong labor market, high earnings expectations, and U.S. equities rotating and proving, even in the face of elevated oil and inflation, there's plenty of room for optimism. So we continue to climb this wall of worry. Hope this was helpful. We'll see you next time. Happy 4th.